Hello again and welcome back to RegalX Trading Academy video courses. My name is Daniel Garcia and I'm your instructor on this video course series. Today in course number 3 of the advanced course series, we will talk about how to use some major indicators and the most basic things I look at when checking the market. So we will start with looking at moving averages and how to use them, what kind of information they give us. We will look at what is called the ATR, the average to true range, and what it tells us. We want to look on how can we try to identify changes in a market and how to apply them into trading. And last but not least, because this is the most important part in terms of being in line with your risk management, how can we use properly designed risks that we're taking, exactly defined what we're going to do. And for that, we will introduce a little tool called the position size calculator that gives you the ability to trade with accuracy, just very simply stated. So let's start with the most simple ones on the MT4. You can add moving averages. For example, I have added a moving average here. What it tells me is that the red line here, the big red line, gives me the average price of the last 200 candles, and it gives me the average price of the last 200 candles on the close price. Remember, candles have an opening price, a close price, a low, and a high, and this red line gets its values from looking at the last 200 candles, and it forms an average out of it. There's different ways to do an average. You can do a simple one, meaning each of every of these 200 are weighted in the same fashion. Every one is worth the same. Or if you do exponential, it means the newer candles message to say 1, 2, 3, 4, 5, the last 5. They have a lot more weight in building the average than the other one. So the more you get to the 200th, it will have the least impact on doing the average value here. And I have a number of those on here. For example, I like to look at them more on a daily time frame because this helps me to guard a couple of things. So, for example, the big one is the 200-day moving average. The red one, again here, 200-day moving average is usually a very important number for markets to shift. And this is what I was saying, is how to identify changes in the market and then think about applying them in the market. So when the euro went up here in the beginning of the year, it was trading over that 200-day moving average since April 2017. Think of that. That's really a lot. And after it broke through here, it retested that average from the downside. Look at this, and when it failed here again, it moved even about 450 pips from the 200-day moving average to the low. So after that was confirmed, the market was not able to push through that very significant price in the market, and for the first time in over a year actually, and then that was a signal for the market that the selling pressure was stronger. It was stronger or turning stronger. The question is, did we know it's going to go forward 50 pips? No, we don't. We can get a better idea that the sentiment shifted from a buy market to a sell market. And that's why moving averages help us to gauge a little bit more how strong a move really is that we're seeing here. So, for example, right now we see the euro recovering, but where is it? It's still caught between the 10-day EMA and the 20 here, so it's not really pushing somewhere. So I have also here the 38, which means it looks at the last 38 days, and the 200. They just help me to also to checking they are all in agreement with each other. Do they look at the same thing? So that's important to do. Now, if we go to the lower time frames, for example, for the 1 hourly chart, it is important to get an idea of what is the average true range, meaning for the last 20 trading days, which is a month. You know, if you look at a month's time without weekends, it's 20 trading days basically, and these two lines here, they help me get an idea about what was the average trading range on a daily basis for the last 20 days. So now we can see, for example, the move that we're seeing right now today is okay. So we came here from yesterday, evening down here, almost at the low of the ATR, now into the middle somewhere, but we're not really into important territory. But sometimes when the market breaks further, let's just, for example, look at the Aussie today so that we can see the RBA today was, this is the Australian dollar. RBA is the central bank in Australia. It delivered a message which was hopeful of expecting inflation to get stronger in Australia. So you can see, boom, the buying interest surpassed the daily average true range massively. And it retested it. Look, it went up, it came down here, but then when it pushed all through it, then that could be seen as a signal, for example, that it's going to rather try to retest those highs here on the hourly chart, where we were just a few days ago, which is in fact happening right now. So you can gauge the daily trading range in order to get an idea of how far could a market go, and if it breaks it, what's the next stop that it might go to, the next station or the next train is going to go into, for example. So this is another very helpful tool. Now, if we want to place a trade, the most important thing of a trade is you should know, what am I doing? Where do I want to enter the market? Where do I want to exit the market? And based on this information, you can very much calculate what size you should do, trading size. And also, you must say, how much am I prepared to lose if you go with trading 101? Basically, you should never risk more than 1% on a trade, maybe 2%, but that's a lot already. So what do we have in this position size calculator here? Let's just get an idea. Let's just say we want to sell back into the Kiwi. It has went so much down here. Kiwi is the New Zealand dollar, US dollar. Let's just say we want to sell now into it. We want to exit the trade if we go above 68.10, and we want to go further down, or we want to exit the trade. Where's the next target? The next target would be around here, 66.70. So 66.70, and up here we said 68. Yeah, about over here 68.20, 68.30. So now we pick up the position size calculator. We go entry level and say entry level right now is 67476. So 67476. We got stop loss level, which is on the top side where we want to get stopped, which we said is 68.30, and that's really all we need to know, because 68.30, and here it tells me risk. Here I can say, all right, I want to risk 1% of my account size on the straight. So now I put in this, and it tells me up here, okay, in order to trade 1% risk, what I need to do is open 1.18 lots on the account size that I have. It shows me this is where my stop loss line. And I mean, we could put in a trade for a moment so that we can see it. I do 1.18. Okay, it won't let me do 1.8. 120 is the next round thing, which is fine, doesn't make a big difference. And we can say we want to sell. So now we have to position the position running here. Where is it? There it is. So we do the stop loss as we said, 68.30, 68.30, and we want to go down to 06610. The next stop. All right, so we say modify, and now we see up here, I can, oops, I should have moved the other one. I'm sorry, no problem. We moved the green one 1 second so they don't overlay. So 68.30 is what we said. All right, so this is our stop loss here. If we lose, we lose. We said 68.20. Here we are. If we go into stop loss, we will lose about 750 euros. If we win down here, we will win about 1400 euro. That's also an important thing to pay attention to. What's my risk? What is my risk reward? So I'm risking 750 to make 1400 bucks. So I'm almost risking health for gaining the full amount, basically, so twice as much. That is a good risk reward ratio. It's 2 to 1. This is 2. This is the 1. So this trade basically, now I put it in and I know if I lose here, I lose 1%. And if I win here, I win 2%. Basically, more or less. And now I know exactly what I've done. I'm not like playing around with different sizes, maybe 5 lots, 10 lots, 15 lots. Don't know what I'm doing really, or not really calculating exactly. So you don't need to be a genius in math. You just need to use the right tools. And this tool helps you immensely in finding the right position size for the trade that you're aiming to do. And because you have to go through your thinking structurally, you will think about it. So you're thinking about the risk. You're thinking about the risk-reward ratio because you think about what is my stop loss? What is my exit? You think about the trade idea. My trade idea is a continuation of that move to the downside because of a strong dollar. I will put my stop loss slightly above the last high here so I don't get stopped prematurely. And I take my take profit at the next support line down here that we've seen in yen. It's 2016 already now. So I have a complete thought done here. The whole structure was built out of nothing, for in the beginning I had not maybe an idea. Now I have a structure plan, and this is really what those tools do to you. They think of a force. You can think with a plan. They kind of force you to think with the plan, and that's when the magic starts to happen in your results. When you try to map your own patterns on when my plan is working, when it's not, what are the reasons for that? So you need to audit yourself on your results, and you cannot audit yourself if you're not going with a certain structure, because if you don't know what you're doing, you don't know what to do differently. And that's why this is a very, very helpful. So I hope in this webinar you've learned a lot. And in the next course, we will talk about popular trading strategies. Until we meet again, have a great day.